Want to welcome you all this morning to this presentation about COVID-19 related legislations and those impacts on farms. I do want to introduce my co-speaker here this morning, Dr. Adam Kantrovich. Most, if not all of you, know Adam from his time here at MSU, but he is now the Extension Associate Professor for Agribusiness and also the Director of Clemson Income Tax School at Clemson University. So welcome, Adam. Adam was saying before we got started that he recently did this for Southern Extension, state extension organizations. So hence the Clemson background on most of the slides that you'll see today, except for the ones that I took over. So appreciate Adam being willing to share this with us as well here at MSU. So today we're going to cover a pretty broad set of topics related to COVID-19. I'll give a short labor update and challenges, mostly related to H-2A workers, but certainly a lot of those things affect our domestic workers as well. And then we'll get into some COVID-19 related legislation, including some, I'll give a background, and then I'll talk about the Families First Act, and then Adam's going to cover things that are under the CARES Act, which is the bulk of the programs that are affecting farms. And then we've got some resource slides for you. I'll also direct you to our farm management page as well, that you can find more information at. So obviously one of the biggest disclaimers is this is changing, as you know, on a daily basis. We're getting new information all the time on these programs. So stay tuned for more specific information as this goes on. That's why we've included the resource pages. And of course, as Extension, we're really interested in giving farmers options that they can choose from and make that decision for themselves. So when we look a little bit at the labor challenges, well, actually the general overview first, this really falls into three large pots of money, if you will. There's the Coronavirus Preparedness Responsive Act, Supplemental Appropriations Act that was passed on March 6th, and that money is going through the Small Business Administration. There are certainly some impacts for ag in general in there, but also specifically for certain segments of agriculture, and Adam will touch on those. Second big pot of money is the Family First Corona Response Act. In other words, the Family First Act. That's a large set of dollars that kind of sweeps farms that aren't used to Family Medical Leave Act type conversations into this pool. So we'll talk about that as well. And then another $2 trillion. This is the big pot of dollars and growing through the CARES Act. So what about labor? Adam and I are both part of a group called the National Council of Ag Employers. We're both members of that. We have weekly calls about H-2A. So we have at least some pulse of what's happening out there. So based on that, based on conversation with farms, we know that, you know, despite the size of this program where we're hiring over 200,000 seasonal workers every year through H-2A, and those are considered essential, we do know that there's certainly some issues with travel restrictions, and there's certainly health concerns that are reducing the availability of those H-2A workers. And in some cases, that's even causing farms to have problems meeting that 3/4 guarantee. In other words, for those of you that don't know H-2A, they're guaranteeing a certain amount of work when they sign that contract, and they have to fulfill at least 3/4 of that from the farm's perspective. They have to provide at least 3/4 of those guaranteed work days. And so as things get delayed, as workers become unavailable, that's made that a challenge. I mentioned paid work leave requirements with the Families First Act. Will be a new learning curve for farms as they head in through that. There are increasing housing and worker safety concerns, and certainly That's a big issue both for local workers as well as H-2A workers and migrant workers. And then we've actually heard some cases where state workforce agencies were denying requests for workers through H-2A because of the statement that there's enough U.S. residents to take the job based on our current unemployment rate. That is normally not a prerequisite and is not part of the H-2A program, so we feel that's misguided, but it still is at least temporarily affecting some of those egg producers in getting those that H-2A requests through. With the consulates, there has certainly been a slowdown in H-2A visa processing, but it still is happening. Specifically in Mexico, where the bulk of our H-2A applicants come through. They are still processing those despite being short on staff at those locations. Normally, in normal circumstances, a worker that's returning after having been here within the last 12 months in the US can be processed without an interview. One of the ways that they're trying to relieve some of the pressure and make more workers available through the H-2A program is they're saying that anybody that has been here within the last 48 months can be processed without an interview. So that's an intended act to try to make more workers available without an interview. Basically trying to keep the people at the consulate safe, workers that are getting interviews safe, basically allowing for a freer flow of workers through that process without an interview. USDA and DOL are also facilitating worker transfers. In other words, if a worker is finished with one job, one contract through H-2A, they can immediately go into another H-2A contract with a different producer that has an approved contract through H-2A. And they've extended the 3-year maximum stay temporarily to try to make more workers available for these H-2A jobs, or for these jobs that are using H-2A workers. As far as housing and worker safety, certainly whether you're working with H-2A workers or working with domestic workers or migrant workers, you're still concerned about social distancing. And that's certainly going to be a challenge for both housing and work conditions, sanitizing equipment between that. We've had a couple of very nice articles come out of Michigan State University on this. There are also some great resources available on Fisher and Phillips, a law firm down in Georgia that has a frequently asked area, and the National Council of Ag Employers has put together a nice list as well on some safety concerns in dealing with that with your workers, and we've included some of that up on our ag business website as well, farm business management website. DOL is relaxing some regulations in support of worker safety. In other words, allowing them to spread out a bit more, performing limited duties outside of the job order, and also permitting work on other work sites that weren't specifically in the job order. So that should help with social distancing and being able to keep workers employed on those farms. Property housing inspections are still required, but may be temporarily waived in emergency situations. So if you do need to, normally you have to have housing inspected before you can put workers into that house. But because of some of the emergency situations that we're at, if we have somebody that we need to provide separate housing for because they're experiencing COVID-19 symptoms, those emergency measures can be put into effect where you can go ahead and put that person in that housing and then have it expected at a later date. And so that's providing some relief and some ability to keep our workers at a safe distance. Let's get into some of the legislation. So I want to tackle first the Family First Act. Family First Act provides employers of a specified size to cover the cost of the employee's leave to COVID-19. So that's the big thing, is being able to be reimbursed for the leave that an employee may need to take because of COVID-19 symptoms, sickness, but also to take care of individuals because of COVID-19. It really breaks down into a couple of main areas that affect farms. There's a paid sick leave part of the act, there's paid family leave, and then there are some notice requirements and posting requirements that are part of this Families First Act. This includes all businesses with less than 500 employees. So that's a pretty big deal because that would cover most of our farms in the state of Michigan are impacted by this legislation. And you do that head count at the time that leave is requested. So if one of your employees asks for leave today because they're sick or they need to take care of their children, that head count is taken at that time. And if you're over 500, or if you're under 500 employees, you are covered by this act. When you're doing that worker count, there's no exception. So in this case, H2A, H2B, seasonal workers, part-time workers, they're all included in the count to determine the size of the employer for this act. And it covers leave that is taken from April 1st through the end of the year. So it's actually been in effect since the 1st of April. One important note is that in the enforcement of this act, we know that DOL knows that there will be mistakes made by employers just from lack of information, not knowing the ins and outs of the act. And so they basically said that for that first month, they'll just be providing correction, not any penalties to those producers. And that may extend beyond this first month based on how this program kind of gets dragged out, but they've at least said that for the first month. The employer doesn't have to obviously pay leave if the company is closed. So if you're not a non-essential service and you have to close your doors, workers are furloughed, you don't have to cover leave under this Families First Act. So as I said, it kind of breaks down into two main areas. There's the paid sick leave portion, and that covers in this first segment if a worker is quarantined by a doctor or by government order. Importantly, that is not the stay-at-home work orders that Michigan has and other states have. That's not what this is about. This is an actual quarantine by a doctor or an actual quarantine by government, not a stay-at-home order. Or if they have symptoms and should have and underlined, they have to be seeking medical diagnosis. So if they meet one of those two requirements, they can have 2 weeks off, 80 hours, and they get that at full pay, up to $511 a day, $5,110 maximum for that 10 days or 2 week period. So that's kind of the first sick leave. There is a second sick leave that is to take care of an individual that's under quarantine. And I put this up in the sick leave part because it doesn't have to be a family member. This could be a neighbor, it could be a coworker that you would be staying home and taking care of. You could request that dollars. If you would otherwise be working, and in this case you can't work because of taking care of that individual, you can request payment. And that, importantly, is 2/3 of your regular pay, but the limit is much smaller, $200 a day or $2,000 for the 10 days. The second big pot is the family leave portion of this Families First Act. And the first part of that is again at 2/3, so it's very similar to taking care of an individual under quarantine, but in this case it's taking care of your child that is home because of school closure. And so that parent could get 2/3 of their regular rate of pay for 2 weeks, 80 hours, again a maximum of $200 a day or $2,000 total. But they can also then get an extended family medical leave for an additional 10 weeks at that same rate of pay. The only additional requirement is that for that additional 10 weeks of extended pay, they have to have worked at least 30 days of the last 60 days that they've been on the payroll. So it's, if you hire just within the last week or something like that, you wouldn't be eligible for that additional 10 weeks of expanded Family and Medical Leave Act. So that totals 12 weeks possible for an individual that's doing the family portion of this act. That's full-time employees. If they're part-time employees, leave is based on the employee's average number of hours over a 2-week period. So you don't all of a sudden get full-time pay if you're working part-time. It is based on your actual average number of hours. If your hours are kind of all over the place, they vary by time of the year. It's based on the 6-month average to determine your daily hours. And if you've been under 6 months, then it's based on your expected work hours when you were hired. So in other words, you're expecting this job to be a 30-hour-a-week job. That's what your rate of pay is going to be based on. Excuse me. It doesn't include anything additional. So this is just regular pay. So anything over 40 hours, overtime, bonuses, tips, that type of thing are not included in this rate of pay. And if you're taking leave for something else that's not COVID-19 related, then this does not cover a reimbursement to the employer under this act. So you would fall if a farm has more than 50 employees in a certain time period, they'll fall under the Family Medical Leave Act, and so that would take precedence then. And of course, we do have state rules as well. In Michigan, we do have the Sick Leave Act that accumulates sick time at 1 hour for every 35 hours of work. So those state rules come into play as well on some of this. Much like Family Medical Leave Act and Sick Leave Act, you can't fire a worker for making a complaint for an employer doing something wrong here or not following the rules. There is a minor exception for very small agribusiness or businesses, and many farms may fall into this, but it's only for the extended portion of the leave. So they still have to follow the 2-week initial leave for school, for taking care of a sick individual, for being sick. They can be exempt only from the long-term portion. And they have to show that it's going to cause the employer expenses to exceed revenue and the business to close, that there's going to be a loss of workers that will create a substantial risk to the financial health or operation capabilities of the business. And the worker is needed for the business to maintain minimal capacity for operation to continue because there are not enough workers that are able, willing, or qualified to cover the worker requesting leave. So there is an exception, but it really has to be a dire circumstance. And remember, excuse me, that they are being reimbursed for this family first leave. So it's really about not being able to run your business without this individual. Employers with the 50 employees or less still have to comply with the other parts of the law and legislation. So I mentioned being paid for this. So who pays for it? The employer needs to cover the cost initially, but the federal government covers the cost in the end. And they do that through an advance or refundable tax credit. And we'll mention the paycheck program as well. Adam will get into that. So this work, employers basically, how they would cover this is they hold back the amount that they would normally contribute to FICA, their employer share, across that entire payroll time to cover the cost of this leave. If that is not enough to cover the cost of that paid leave for an individual that that request this leave, then they can file a special form. It's called Form IRS 7200. They get that to the IRS, and the IRS will reimburse them for that difference, and they're expecting that turnaround to be 1 to 2 weeks, or expecting a very fast turnaround on those payments. An important note, and Adam will get into the Paycheck Protection Program here in a little bit, but one of the important notes is this could affect the eligibility for the forgiveness of the Paycheck Protection Program. So this will become more clear as Adam talks about it, but basically you're reducing your payroll that would be eligible for the Paycheck Protection Program, because the Families First Act is covering for a portion of that payroll for that 12 weeks that an individual may be taking off for Family First. So keep that in mind. Adam will get into more details on that, but it could affect that forgiveness. Our thought currently is that there still may be a partial forgiveness, but we don't have good guidance on that yet to say whether that would be a total non-forgiveness of that Paycheck Protection Program or a partial forgiveness of it. So that's
Stan?
Yes, go ahead, Adam.
Ben Whirling, in case those that weren't reading the chat, asked a good question. I've already responded to that, but it is very important that records, as it relates to individuals that are approved to take leave, to provide the records to the employer to prove the reason necessary for that, because the employers are going to be required to hold on to those records in case of audit at a later date.
Yeah, that is a good point, Adam. So if there's going to be forgiveness, complete forgiveness or partial forgiveness, despite having used this program, it's going to be because you've got really good records to show how you've utilized those that program to cover that leave. So I mentioned a notification requirement as well. And again, we do have links on the Farm Management Team's webpage. We have a special page set up for the COVID or the coronavirus impacts to agribusiness. And there is a link in there to the notifications that are required, but there is a poster that is available in 7 or 8 different languages that you need to post, much like you would your other workforce posters. If that individual is working telecommuting, working from home, then obviously you can send that by email as well as have it posted at the farm or business. Is there any, Ben asked one specific question on that. If there's questions specifically about Families First, we could take 1 or 2 of those. Otherwise, we'll save those for the end, and I'll turn it over to Adam. I'm going to stop my screen share here. Adam's going to share his, just so that he doesn't have to tell me next.
Okay, can everybody see my screen?
Yes, clear, Adam.
All right, so we're going to start off. Stan has covered the first major, the first piece of the COVID legislation that took place had really very little effect within agriculture, although there were some funds that were pushed through to the SBA. Most of that was dealt with for health purposes as it directly related to COVID mitigation. And then we had the Family First Act that really began to produce and appropriate funds that began to have an effect for some of agriculture. And then the Coronavirus Relief and Economic Security Act really kicked in the big stuff. And so we're going to talk about 2 or 3 major components here. We're going to talk about some of the challenges and issues as it relates to this particular piece. So first, to kind of give you a basic background on the amount of money that has been appropriated and where these funds are going to through the CARES Act itself. You can see what we've been hearing in the media has been small businesses, and straight to individuals through a variety of the programs, specifically the Paycheck Protection Program, the EIDL loans, which is the emergency and injury loans, as well as the economic impact payments that checks have already started going out, or at least electronically deposited for some of our taxpayers that are out there. But if you take a look at this, we can see significant portions going to corporate loans, grants going to airlines. And so it is covering a slew of industries. And this is just another way to show some of those funds and how it's funneled. When we get done with this, Stan and I will provide this presentation in PDF so that you can take a look at this and you'll be able to see this a little bit easier. But as we begin to move into specifics as it relates to ag, because that's really why we're all here right now, there was a specific line within the CARES Act that appropriated $9.5 billion direct to the USDA for the Secretary of Ag to utilize in a fashion. And what was important about this particular line item is it specifically called out a few groups that usually are not able to receive funding at the same levels as many other parts of agriculture. And that was the specialty crop growers, livestock producers, and dairy farmers, even though the dairy farmers do have a program available to them right now. And so that was really important. Then there was $14 billion that was provided to the CCC, the Commodity Credit Corporation, and the Commodity Credit Corporation is where funding was appropriated a short time ago last year to help mitigate some of the issues that arose with commodity prices due to trade, and that created the Market Facilitation Program. And at first, we weren't sure how that was going to be used, and in a little bit, I'm going to show you how that's going to be used, because we now know as of about 72 hours ago. Then there was $349 billion that was actually put to the Small Business Association. However, it was just because they already had a system put in place to be able to utilize the funds in a more efficient manner, or at least there was the thought of that occurring. However, there were a significant amount of issues that arose through the SBA, and we'll talk a little bit about that in a little bit. But that is where we saw some significant amounts of funding that was appropriated that were able to be utilized by some of our farms. There was another $15.8 billion, or almost $16 billion through SNAP, 8.8 for Child Nutrition Program, another $100 million to Reconnect grants for broadband in rural America, $55 million thrown into inspections and protections for invasive pests and animal diseases, $33 million for food safety inspection. And how is this going to be used, and what is really going to affect us? Well, on Friday at a press conference at 9:00 at night, Sonny Perdue unveiled the Coronavirus Food Assistance Program, or what they're calling CFAP. And it's going to take, initially, there's about $33 billion. It takes an initial $19 billion, takes $3 billion of that, and is going to be used to purchase ag products for distribution. Another $16 billion, which came from the $9.5 billion from that emergency program through the CARES Act, and then it's taken $6.5 billion out of the CCC funding, and that's going to be utilized for some direct funding. And then it's going to take the remaining $14 billion through CCC that was placed in there, and that is expected to be utilized sometime in July. So the $3 billion for purchase and distribution, what it's going to do is take $100 million a month at first, purchase a variety of dairy products, another $100 million in meat products, another $100 million in fresh fruit and vegetable products. And this is going to be sent to distributors. Those distributors are going to take these products and box them up, and then it's going to be sent off to food banks, religious organizations, and other community organizations that feed the needy. There's an additional set of funds that USDA are going to be using that you can see there, the Section 32 funding, as well as some additional funds through Families First and CARES Act to be able to assist with additional food purchases going to food banks. Next, the direct payments. So the $16 billion in direct support to producers is going to be utilized based on actual losses for the 2020 marketing year that was caused directly by COVID. And the way this is going to be broken off and how much is used for which commodity group. 9.6 billion is going to be used for livestock producers in general. 5.1 for cattle. So that's going to be our beef cattle, 2.9 for dairy, 1.6 for hogs. 3.9 is going for row crop producers, 2.1 for specialty crop producers, and 500 million for other crops. And when asked, Secretary Perdue stated that, there's possibilities of looking at that other 500 million. In there might include sheep and goats. This could also include honeybee production, may include hemp. I'm not sure why hemp is not considered part of the specialty crop. So it's yet to be determined really on where those fundings or those appropriations are going to be utilized. Direct payment limitations. There is a $125,000 limitation per commodity. The overall total limit per individual or per entity is going to be at $250,000. So what that means is if you have a farm that's an LLC, there's 4 equal shares, owners 25% each, and it produces 6 commodities, and each of those 6 commodities meet the criteria to receive the maximum limit of $125,000 due to those losses, which in theory would bring a total check of $750,000 due to the entity limit of $250,000. Each owner would only be able to receive $62,500 due to the limitation rule. Now, under that same scenario, if it was a general partnership, each owner would be eligible for $187,500, which is still below the individual maximum limit of $250,000. Now, how is that set? How do we prove, what qualifies a crop for a loss? That loss, if I didn't make statement of it, and I thought I had a slide in here, is a 5% loss. And so there's actually there's 2 mechanisms that are going to be utilized for 2 equations that are going to be utilized to determine that. So one, you have to be able to prove that a crop has a 5% loss between January and April for that particular crop. So if you're a dairy producer, it's relatively easy. I'm going to be able to show my milk checks. And so the first portion of that equation is going to have is going to cover 85% of that loss for that crop. The second part is going to cover 30% of the loss for the next 2 quarters following April 15th. Now, a couple of other, and that's what qualifies a crop as for receiving a payment. Now, although there's a number of other things that are unknown yet with some of the gritty details of this, there have been some rumors that this could mean for a beef cow-calf operation upwards to about $150 per cow. However, we don't know, and if this is going to be state-specific or if it's going to be nationwide. There's been some rumors in some states that could see upwards to $41 an acre for pasture. Again, we really don't know. Some basic recommendations is make sure that the farmers presently have good production records to be able to show what they may have had in inventory, what has been sold, if anything has been sold during this time period and on what dates, future planting and planted and production records as well, and that farmers have the means to show that each of their products that will be marketed in 2020 marketing year may have seen that 5% drop in value. Any questions? So it looks like there's 2 questions coming in with regards to that. And let's see. Stan, you need to watch those questions for me in case they come in.
I was just replying to Ben's first one there about losses after April that are not covered. So they are covered, but not at the 85% level.
Well, we don't, I guess we don't know how that's going to take place backwards. we know that the equation itself to determine the actual paycheck, we don't know if there's going to be two checks or if that first check is for what took place between January and April. And then it's going to be an anticipated loss moving forward, or if there's going to be a second check. We just don't know right now. We can also tell you that the expected deadline or the expected sign up is going to be early May, because they would like to have the first round of checks going out by the end of May and early June. So be prepared. I've been telling folks now already, begin to contact and watch for the FSA office to see when they have that. Most FSA offices, as of yesterday afternoon, still did not have much of the details. When I made a contact to FSA in the morning, yesterday morning, on exactly, was this going to take a simple route to be able to make some of these determinations? And the response was the simple method, that train has already gone off the tracks. So we really don't have the full details yet on all the nitty gritties. So keep an eye out.
Adam, there were a couple more questions in there. One was affects, how does it interact with current insurance program enrollments? And then, if there's a loss, well, deal with that one first, and then there's another separate question there.
The reality is right now we don't know how that is going to interplay with regards to insurance, if this is going to be on top of that, or if you have revenue insurance of some type. Is there going to be interplay, whereas if this is going to make me whole to a certain level and then the insurance value that you would receive is going to decrease? That would be the expectation, but a lot of those details are just unknowns.
Right. And then Ron Goldie asked a question about losses in crops where it's, for instance, an annual crop that, maybe they don't have the resources because of this, worker-wise or otherwise, to plant acres. So they wouldn't realize that loss until until a later date, or it may not be easily calculated for that April 15th calculation.
Correct. We do not have the nitty-gritty details. They are still, we expect them to come out within the next week to 10 days. And that might be overly optimistic, but we just have to see how that's going to play out. We don't know that if due to labor, that's going to change my planting decisions, or if this is going to be based on the last 5 years, Olympic averages. We just don't know.
Right.
Any other questions?
Not at this point.
All right. Thank you. So we keep moving on. What do we know presently? So let's start talking into the $349 billion in small business loans that was initially put in and appropriated through the CARES Act. And so we're going to talk about Section 7A, which includes the Paycheck Protection Program. And agriculture was specifically mentioned in this within the CARES Act to be eligible for this program, because typically when you go to SBA prior to the CARES Act, what they would tell you is you are a farm, you go to FSA. We don't work with farms. However, through their typical EIDL loans, there were certain carve-outs for certain portions in the past, which included greenhouses, but those were very, very limited. And the CARES Act expanded Section 7A of the SBA Act, which included agriculture, and this also included some small co-ops that may have been eligible as well. 7B, which is the Emergency Injury Disaster Loan, also referenced as EIDL. That one, although what we're hearing from folks up on the Hill, their intention was ag to also be included in this. However, it was never specifically mentioned within the CARES Act, which reverts EIDL back to what the SBA will refer to as their SOPs, standard operating procedures, which goes back to ag doesn't count with the exception of those couple of carve-outs, which was in this case greenhouses. But the big question is, as we heard over the last week, it ran out of money relatively quickly. And what we've got going on is today, Congress is going to attempt to appropriate additional funding with a bill. And as of yesterday evening, or actually yesterday morning, what they were hoping to do is have $300 billion for SBA Paycheck Protection Program, $50 billion going into EIDL. And then there was going to be some additional funding going to hospitals and additional funding going for testing. The Dems and the Republicans still had a couple of bones of contentions with a few other pieces, both wanting to make some modifications to eligibility, as well as some additional pieces coming in there, which increases or changes sick leave, how that's appropriated, funding, and those types of things. And so we'll see if this is able to get passed today. Now let's move into the actual nitty-gritty of the Paycheck Protection Program, which is part of SBA Section 7A. The basics: farms and ranches are eligible, as I already made mention. Businesses must have been in operation on February 15th. Here's a very important note, because there's a lot of details that still have not come out with regards to rules or quote-unquote guidance from the Department of Treasury and or through the SBA. But early last week, they did provide some guidance with regards to the self-employed and independent contractors, and this includes the bulk of our farmers. And although you needed to be in operation by February 15th, and if you were a normal quote-unquote business, if you were in business by February 15th, but not in the prior year, you would use payroll from January 1 through February 29th to make some determinations with your eligibility, loan amounts, etc. However, this guidance changes that for self-employed and independent contractors, and you are required to use your 2019 tax returns. And if you had not filed your 2019 tax return, you would need to at least work through that to come up with a number. So it's important to note that. Businesses must meet SBI size standards. This is available through lenders that are approved to service SBA loans and programs, and this includes many farm credits that went through the very quick process to be able to be approved to do that. The maximum loan amount is going to be the lesser of $10 million or 250% of average monthly payroll costs for 2019. And again, the exception is if you were not in business for normal businesses or not in operation in 2019, you would use your average payroll between January 1 and February 29th. The exception is self-employed and independent contractors. The term or maturity of the loan is 2 years from the point of forgiveness determination. Now, the legislation itself had a term of no more than 10 years. However, when guidance came out, there were specific comments with regards to that, and the secretary essentially made the decision that we're going with no longer than 2 years, because that's all that would be needed, because this is going to be a short-term issue. The legislation also states that interest is not to exceed 4%. However, within the rules or guidance, it provides that the interest to be 1%. However, we have also seen that there has been interest rates as low as 0.5%. So who is actually eligible? Generally for businesses that employ 500 or fewer employees. And we've also seen contradictory information between places where it is fewer than 500. So just a note. The PPP loan is to cover small business concerns and business concerns, any business concerns. This includes also 501c3 nonprofits, veterans organizations, tribal business concerns, self-employed and independent contractors, any businesses within specific industries, and meets applicable SBA size standards for that industry, even if it employs more than 500 people. And this gets to the business, and also businesses with a North American Industry Classification Code beginning with 72, which includes lodging and restaurants. And the reason why those last two bullets are important, we have mining in Michigan, we have mining here as well in South Carolina, we've got some gold mines. And so technically gold mines that may employ upwards to 1,200 people may also qualify for this PPP loan. Who is not eligible? Anyone engaged in a federally illegal activity, even if it has been legalized at the state level. So that means no marijuana businesses are eligible. Nobody that raises it or farms it, whether in greenhouse or open field, nobody that sells it, etc., is eligible for this program. Household employers are not eligible. Any business that has somebody that has a 20% or more equity stake that is presently incarcerated, that is on probation or parole, that is indicted, or has been convicted of a felony crime within the past 5 years is eligible. This last one is very important, and you're going to have to work with farms because we have seen this come up over the last couple of years frequently. A business that is owned or controlled by someone that has received a direct or guaranteed loan from from SBA or any other federal agency that is currently delinquent or has defaulted within the last 7 years. And we have seen this especially with regards to delinquency for FSA agency loans. Maximum loan amount determination. How do we begin to figure these things out? So maximum loan value is going to be the lesser of 10 million or 250% of the annual monthly average payroll cost. Startups not operating prior to 2020 will use average monthly payroll, as I've stated before, between January 1 and February 29th of 2020. General employers with employees, 250% of average monthly payroll cost for 2019. Seasonal employers will use the 12-week period beginning on February 15th, 2019, or they may choose to use a 12-week period from March 1st, 2019 through June 30th, 2019 to determine average payroll cost. Self-employed with no employees. As I stated, guidance came out early last week that was really specific with this, and this created some issues also for farms going to apply for this at banks, and I'll talk about that later on. The guidance came out and said, you will use Form 1040 Schedule C, line 31, which is the net profit amount. It never said anything about 1040, but the equivalent line to use would be line 10 on the 1040F, line 34, okay? So technically, if that line shows 0, because many farms that we have use inappropriate tax management strategies of, I don't want to pay taxes, instead of utilizing how to get enough to be able to maximize the amount of money through the system at the cheapest rate possible, right, Roger Betts? I saw you're on there. But if their line is 0, you're not eligible for a PPP loan. You've got to have money and or payroll costs to be eligible for a PPP loan, okay? The other thing that is of note, if the line is above $100,000, so let's say it's 150, the maximum limit is going to be $100,000.
We'll have to do everything.
So a reminder, folks, to please mute your mic if you're not talking.
Okay.
So if that line has 150,000, what you're going to do in the equation is remove that 50,000 or any dollar amount above 100 and just pull that 100,000. You're going to divide that number by 12 $100,000 by 12, and then you multiply it by 2.5, and that is going to be your maximum loan value that you can take out. Now, if idle loans were also used, there are additional steps, and we'll get to that a little bit later on. So, some self-employed issues. Because of this equation, the self-employed are required to use. It is all but impossible to have the entire amount forgiven if I actually take out the entire loan value. So the reason for this is the second part of this equation. So for PPP to be actually considered for being forgiven, 75% of the loan amount must be used for payroll, okay? And or self-employed earnings compensation for the 8-week coverage period with non-payroll approved purposes not to exceed 25% if we want everything forgiven. The actual equation for the following will be shown on a later slide. So if the self-employed, if we assume had $100,000 in the appropriate line, we divide that out, our loan value is going to be $20,833. However, by doing an equation on that 100,000 divided by 52 weeks, multiplied by 8 weeks that I'm allowed to compensate myself, I get a maximum value of $15,385. And unfortunately, that value only equates to 73.8% of the maximum loan value. So that means we're either going to have a potential reduction in what can be forgiven if I in fact use the entire maximum loan value. So now, whatever does not get forgiven will roll into a loan of 2 years at a rate of 1%. So we have to consider that as well. Farms and businesses with employees will be able to utilize payroll. So the next thing is, what do we include in payroll? That includes salary, wages, commission, or anything similar to that. Cash tips or equivalent. Vacation, parental, family, medical, sick leave that is paid for by the employer. Any allowances for dismissal or separation, meaning if I had to fire someone or get rid of somebody and I paid a compensation value to that individual. Any employer paid portions of group healthcare coverage, insurance premiums, retirement, etc. Any state and local taxes on compensation that had to be paid for by the employer all counts as payroll. What is not included? Any compensation to an individual in excess of $100,000. So if I have somebody on my payroll that makes $125,000 annually, what I would have to do is just plug in a number of $100,000. You're removing anything above that amount. When I have to figure out the annual or the monthly average across the year for that payroll. Any federal employment or employer share of withholding taxes or RRB Act taxes, only the employer share is removed. Any compensation to those whose principal residence is outside of the U.S. And this brings up the H-2A issue, and we will talk about that on a later slide. Anything that qualifies to be covered under the Family First Act. And so if I make the choice, because if I have an employee that is taking 2 weeks of sick time at full pay, or taking any of the 2 weeks or 10-week options under the family leave, and I am reducing my employer share being paid into the FICA to be able to cover those costs, those have to be removed from these numbers. Any qualified leave wages for which credit is allowed under Section 7001 or 3 of the Family First Act. So anything in essence that I am using to take already as an advance on a tax credit, or if I'm going to be using for tax credit purposes, have to be removed from these equations. So what employees have to be counted to determine maximum loan amount? Anybody that's full-time, part-time, or other basis, usually we consider as variable hour folks. There are specific calculations, as I've already talked about, for seasonal employers. H2A and H2B. There is confusion and a lack of guidance that specifically discusses H2A, H2B guest visas. SBA and many banks will say, because of the non-resident clause that is in there, that they will not accept any applications that have them included. However, there are many arguments on the other side that will show that they should be counted. So the recommendation right now is going to be based on a farmer's, how risk adverse that farmer is. Because if I put them in and it's able to go through and it is later determined that they do not count, at the very least, they may not have anything that will be forgiven out of that loan. And if they're okay with a 2-year loan at 1% and having to pay that back, fine. At worst case scenario, if it is determined that it is not allowed, potentially immediate payback. The fact is we really do not know the full potential of what those penalties are because it's just not noted. So on forgiveness. So the PPP provides covered loans during the covered period. The covered period is going to be 8 weeks following when the borrower receives their funding. You have an 8-week period of time to expend those funds for approved purposes. Potential forgiveness can only be used for expenses considered eligible and only if 75% of the loan value is used to cover payroll. Otherwise, there will be a reduction in the amount that will be forgiven, or you will not be approved for any of the loan being forgiven dependent on the circumstances. The loan can be used for obviously payroll. That doesn't cover any annual dollar value above $100,000, and it does not include many benefits. It does include many benefits, but not any comp. It does not cover the employer share portion of FICA. Utilities are covered for the 8-week period and also may cover gas for vehicles that you use for work purposes. It is also allowed to be used for any rent or lease for the covered period that were already in place by February 15th. It will also cover interest on loans that were already obligated by February 15th. This includes land and personal property. It will not, for most cases, it probably, or we are making the determination, many of us are saying it will not cover operating loans because of the way it is written into the legislation and written into the rules, all right, based on them utilizing the terms of mortgage. And with the next set of rules that came out, it seems to open it up that it will, in fact, include personal property assets, which machinery and equipment would be covered. It does not cover prepays, operating loan interest, etc. Maximum loan forgiveness will include the maximum loan amount plus any accrued interest at the time. Again, 75% of the total is required to be used for payroll and owner compensation. No more than 25% can be used for utilities interest on approved debt. Now, here is a tricky part because we have seen farms and other businesses that have either reduced wages or has actually laid off individuals or furloughed individuals this year that were on payroll or in the previous year. And even if it wasn't that same individual, they have reduced their numbers. If any numbers were reduced or wages reduced between February 15th and April 26th, you will have a portion of your forgiveness of that loan reduced. However, if you bring up the head count back up and the wages back up to where they were by June 30th, As long as those reduced wages or furloughs have been eliminated by June 30th, you are back to having potentially 100% of the loan eligible for forgiveness. All right. What if I employ H-2A or H-2B workers? Again, right now, for many folks, they are saying, sorry, they cannot be included in payroll, and that significantly reduces the loan value. If you can tolerate a significant amount of risk and your bank that you're going through is willing to make the attempt to put it through, go at it. A couple of the groups I've been working with have been working with the Secretary, Department of Treasury, trying to get clear, specific guidance with regards to this, and that is yet to have come out. Independent contractors and self-employed, both are eligible. We've already discussed some of the issues, and so the recommendations right now is to make a determination based on the equations within the final rule. And again, we'll go through those equations at the end of the slide set, because we're also going to integrate some idle pieces into this. But we're telling some of those folks that you don't have to take out the maximum value. So just bring down the maximum value if you're approved to be able to take out the loan, and make sure that the owner compensation is at least equivalent to 75% of the total loan value. Partnerships. Here are some major questions and a couple of issues. One, it is specifically stated within the rules that an individual can only take out one loan. And if you have a partnership, the loan must be taken out at the partnership level. And then the individual partner is not allowed to take out a PPP loan for themselves against that partnership. It has to be done at the partnership level. However, we don't know if the maximum, if the partnership has the capacity, if the maximum loan limit is $100,000 at the entity, or is it $100,000 per partner within the entity. We just don't know that. And we also don't know what happens with guaranteed payments. If the partnership provided guaranteed payments to a specific partner, but because an individual is not allowed to take out a PPP loan for themselves against the partnership, how that guaranteed payment is going to be allowed. And right now it looks like it's essentially lost, because we do not have clear guidance with regards to that. We also don't know if you're at the partnership level, if that also counts as an individual within that as your one PPP loan. And if I am also farming on my own, if I'm also able to receive a PPP loan for that separate entity. There's no clear guidance on that right now. What does forgiveness process look like? We don't know. They have not come out with any of the specifics or details with regards to that. We are seeing still continued banking issues unless things have been able to be resolved in the last 48 hours. We were seeing banks reaching their allowed limits based on their equity positions and not being able to lend out any additional loans. There were still continued software issues between banks and SBA. And we were also seeing different banks asking for different questions, and all the banks were not interpreting the rules the same way. And so if you have an issue, we were telling farmers, go to another bank that we know is accepting it in this fashion, in this form. And of course, SBA in many states and even at the local level in some occasions were incorrectly stating who was eligible and who was not based on income size and other criteria. So we still don't know everything. There is still a lack of guidance in some areas. Be careful on your decisions. Think of this going into it. You're taking out a 2-year low interest loan, and we hope to have it forgiven, but don't guarantee on that. There were some individuals, some discussions on if necessary, and we have not filed our taxes yet, that there's ways to increase the farm's income by not utilizing Section 179 and bonus along with that. But then when you do the numbers in some cases, or in many cases, the extra tax that I'm going to have to pay in some of those scenarios will outweigh any benefit that I'm going to receive from a PPP loan based on the various sizes of some farms. So you just need to do the math and figure out what's going to be the best situation for that particular farm. All right, any questions on that before we go into EIDL? Stan, any come through?
No, we had some back on the USDA programs that I've addressed in the chat box.
Okay. All right, so moving on to EIDL. I'm going to try not to spend nearly as much time on this, simply because it is very, very focused and limited. However, I do know and have worked with some greenhouses that have started utilizing EIDL, and in many cases, they've made the decision they're going to utilize EIDL. They are not going to go for PPP, although in some circumstances it would make sense depending on the situation. This is the economic injury disaster loan for small businesses. It's a traditional disaster loan for businesses, not agriculture, which is typically serviced by the USDA. However, greenhouses and a couple of other weird carve-outs do qualify. Ag qualifies but ag can potentially qualify for EIDL as long as they can prove that for these specific purposes, there is no other source of funding or program through FSA. And I will tell you that SBA is going to make it very, very difficult for a farm to prove that. Now, here's one of the cool things about EIDL, which is why people were very interested in it, is because when you go in to apply for an EIDL loan, you can receive an advance on that loan of up to $10,000, which does not have to be repaid. It is to be received within 3 days of your application, and it doesn't have to be repaid even if your EIDL loan is denied. If the applicant receives a PPP loan and an EIDL loan, the EIDL loan amount will automatically reduce a portion of the PPP loan that is to be forgiven. All right, so that $10,000, it's specific to the advance, that $10,000 will automatically be subtracted from the forgivable amount of the PPP loan. Now, the EIDL loan can be used to cover costs that cannot be covered due to reduced income, such as employee sick leave, payroll, increased material costs, rents, mortgages, and other obligations. However, there may be additional things at play. We do not have all the guidance yet with regards to the Families First Act. All right, we just don't know how a lot of this stuff is going to be played out. So there may be reductions in what can be used if you are utilizing some of those other options available through the Family First Act. So EIDL is going to be available through December of 2020, and the exact day is actually dependent on the state. So you need to go to the state SBA office to find out, is it December 15th, is it December 30th, is it December 1st, etc. Recipient eligibility: businesses with no more than 500 employees, individuals operating as sole proprietors or as independent contractors, cooperatives with no more than 500 employees. This also includes small ag cooperatives. However, there is a significant other series of criteria that you have to show. Tribal small businesses, a business that is deemed to be small as defined by NAICS, and private nonprofit organizations granted under 501c, Ds, and Es. So ag enterprises and EIDL. CARES Act did not modify the provisions that accepted ag enterprises, as we talked about earlier. Small ag cooperatives were specifically included. Greenhouses are eligible, and there is evidence, multiple locations, that Congress did intend this to be included for ag enterprises, but unfortunately it got left out of the writing, And so now there has to be clarification either through additional legislation or through additional guidance, which has not come yet. So terms of EIDL: maximum $2 million depending upon economic injury proven. The loan will not be forgiven beyond the $10,000 advance. Interest rates are 3.75% for small businesses, 2 3/4 for nonprofits. You have an automatic 1-year deferral, but interest accrues immediately. The maximum term is 30 years. However, based on an applicant's financial condition, SBA from the get-go may say, no, we're only going to allow it to be 10 years. And in theory, if the applicant's financial condition gets better, they can go ahead and say, no, 5 years or 7 years. And so you need to be aware of that and prepare, and potentially, based on cash flow needs, be ready to find other funding sources if necessary. EIDL terms: loans of more than $25,000 are required to be secured with collateral. Loans of $200,000 or more must have a personal guarantee. So anything below $25,000 requires no security, no personal guarantee, and no collateral. The CARES Act waives the personal guarantee requirements for loans of less than $200,000. Allowed uses: employee sick leave and payroll. Again, we're still waiting on some additional details and guidance because this may have potentially some interplay with regards to the Family Care Act. So we need to see how that's going to play out. But we believe it shouldn't be an issue right now. Accounts payable, operating expenses and material costs, rent, fixed debt, some mortgage interest and other interest payments, but not principal or other prepayments, and additional other obligations. Disallowed uses of EIDL loans: it is not allowed to go for business expansions. It cannot pay cash dividends or bonuses, and it may not be used to pay any officers and owners unless they are directly related to services performed for the business. You can apply for both EIDL and PPP, as we've intimated in the past. Loan funds cannot be used for the same purposes, however. So you need to keep detailed records on specific payments and what accounts they are coming from. Many have been recommending to open up a separate checking account for each of these loans. And that will be an easy method to help show and keep, obviously, all records associated with all expenses coming from those accounts. So keep those documents used from the funds for each of those loans. If you use EIDL for payroll, PPP loan proceeds must be used to refinance the EIDL. So if I took out an EIDL loan, it was used for payroll, and I go to take out a PPP loan, those loan proceeds are required to be used to refinance, in essence, the EIDL value that you took out. You're paying off the EIDL portion of that debt. EIDL advance will reduce PPP loan amount of forgiveness. Accept the PPP loan first, then consider the need for EIDL. If it works out in that fashion, that might be a way to go. EIDL application comes through SBA, so you have to go to SBA for that one, and it is going to be open through June 30th as long as funding is available. Applications come through lenders, and there is a link through SBA that you can take a look to see what lenders have been approved within your zip code areas. There is the link for the EIDL application. A couple of quick differences. Interest rates for loans right now, PPP is 1%. However, I think it's also important to note that, again, technically the legislation has not to exceed 4. EIDL is 3.75. And when comparing Farm Service Agency loans, these were, as of about a week ago, for the differences between the operating loans, microloans, et cetera. And so just based on interest rates, depending on your cash flow, it might be of value to put in just to get a low interest loan for a couple of years versus an emergency loan through FSA as long as what you can get from PPP is enough, okay? Or you may mix some of those things. So here's a sample farm that has no employees. 2019 net farm income was 120,000. The PPP maximum that is allowed is $100,000. So you're going to peel off when we start moving forward with all of our calculations, anything above 100,000. You take the $100,000 to figure out my maximum loan allowed value, divide it by 12, multiply by 2.5. That gives me $20,833. So 100,000 divided by 12 months, multiplied by 2.5. Now, how do I figure out what I can get maximized for owner compensation due to the potential loss within the 8-week coverage period that I'm allowed? So you take that $100,000 and divide it by 52 weeks. That gives you just over $1,900, I believe it is. You multiply that by 8, and that gives you a maximum owner compensation value of $15,385. So if I'm self-employed, I have no employees, I take out the entire maximum value of the loan allowed to me, and I spend 100% of that value, I'm going to have a problem, because the $15,385 is not a total of 75%, it's only 73.8. So what that means is that extra loan value above that is more than 25% that can be utilized for approved purposes. And so again, we don't know some of the gritty details. There's a lot of people making assumptions on how it's going to work, on whether or not forgiveness will just be reduced a certain proportion, the difference between what was used and what wasn't used. But we also have a number of individuals that have read into the legislation that it may completely allow or not allow any of the loan value to be forgiven. And so really what we are telling most folks is, if you go ahead and you watch what you spend, do not expend the entire amount, utilize the $15,385 for compensation, reduce the amount that is being used elsewhere, or reduce the value that you take out, we can go ahead and limit what is not being forgiven. So in theory, we might have, in a best case scenario, we follow through with some of these games, you may have to repay $321 under best case scenario, which isn't that big of a deal. So there's different ways to look at these numbers and trying to figure out the details, but again, we don't have the gritty details of how they are going to work the forgiveness. So if I have a sample farm with employees, we have a net farm income of 120,000. That, again, you're going to have to pull off that 20,000. This is coming from your 1040F or your Schedule C if I'm a regular business. And I have employee compensation. I paid one employee 110,000 throughout the year, another employee 70,000. But because of the maximum per employee limit of $100,000, we are going to utilize that total annual cost plus the 100,000 net farm income number and add those together for 270,000. That $270,000 gets divided by 12, multiplied by 2.5, and you have a maximum loan limit that this person can take out for PPP purposes of $56,250. Now, to figure out what goes to the owner for compensation, total compensation for 8 weeks, I'm going to take the 270,000. I'm going to take 100,000, divide that by 52 weeks, multiply that by 8, and that's going to give you the owner. However, the total value that I can provide towards payroll and owner compensation is 270 divided by 52 multiplied by 8. which allows me $41,538 that can be utilized for payroll purposes. So that would allow, if I take a look at the loan value and figuring out what can be expended on non-payroll purposes, all right? Total spent on allowed non-payroll expenses. You're going to take that 40, it's going to be 41,000 divided by the 75%. And so I'm going to have a total of $55,385 that I could really use between the 41,000 of payroll, and then that leaves me 25%, that difference between the two, that I can use for rent, I can use for utilities, etc. Okay? Whatever's not utilized gets rolled into a loan. All right? If used for approved purposes, portions of it may be forgiven. Farmer may use no more than 41 for compensation and payroll. If the 41.5 is not spent on owner compensation and wages, then forgivable amount will be reduced. Loan to be repaid would be about $856. All right. Farmer receives idle loan in addition to PPP, can refinance the idle. That's made between January 1 and April 3rd, but the term for that idle loan, even though I may have had a longer term for idle, will automatically be reset to 2 years. So that is going to be a big piece that somebody has to remember from the terms. If idle was used for payroll expenses, PPP must be used to refinance the idle loan. You'll get the lower interest rate of 1% versus the 3.75, but it's also for a shorter term limit. Proceeds from the advance up to $10,000 of the idle will be deducted from any loan forgiveness amount that was available to you through the PPP loan. It's necessary to keep meticulous records during that 8-week period. Try to have all expenditures done for the 8-week period. And what is normal for many farms, I might be paying rent in November. I'm not paying it in April or March. So what you may want to do is work with your landlords or whomever else and pay the 8-week value for your land rent payments within that 8-week period. So you've got the records to be able to show that's what what the funding went for. And you're going to want to do that for any, interest on my debt during that 8-week period of time, etc. Recommended use separate bank accounts unless you're able to really maintain very good meticulous records elsewhere. Be sure to spend the proceeds on approved items only. And here are some additional references that you can seek additional guidance. All right. Before we move forward, Stan, questions?
I've addressed a couple in there, but I'll bring them up to you anyways. Adam, had one question about, things are always changing. What would be our kind of general recommendation as far as applying for these programs? I advise producers to, sign up sooner than later, just because funds are limited.
Yep.
But obviously being aware of some of the program interactions that Adam has covered today is important as well.
So I think you got to take a look at everything in the bigger picture, but I would still at least jump at the fact and apply. You'll still have you may have a few days between applying and approved and when funds are dropped in. And for most farms, the value is going to be relatively insignificant. I've actually ended up, for some reason, talking with a lot of dairy producers over the last week and a half, and very few of them were able to really take out a loan of any sort of value. I don't think anybody was really able to get, I think the most for most of the smaller dairies was about 40,000. There was a couple of larger dairies that were able to get above that and into the low sixes. I was on the phone with a veggie farmer yesterday that they were able to get close to about $250,000. So there are some larger numbers out there that can be utilized. And that vegetable producer also uses significant H-2A workers. and they did not include their H-2A workers within that. And they also recognized that a large portion of their loan will probably not be able to be forgiven because of that. So you got to take a look at it in totality and what the needs of the producers are. But I think it's worth applying for. And if it can be worked out very well, you might have 100% of that forgiven. So it could be very beneficial.
And Ben asked the question, do lenders like Greenstone understand the details of the Paycheck Protection Program so that they can give guidance to growers about how to spend the money of their loan to get it?
Some do, and some do not. And part of it's because guidance was coming so fast and there's different interpretations within that guidance. And what we were finding was even the middle management at some farm credits and other banks were providing different guidance to their loan officers. And that shows you the confusion. And this is probably now the first 4 or 5 day period we've gone through without any new guidance or rules coming out. And so unless something has come out this morning, that was actually as of yesterday afternoon. So it's constantly changing. And what we saw last week after the guidance came out midweek referencing Schedule C for self-employed and independent contractors, there were a number of banks that stopped accepting and processing farm applications because they took that rule and separated out from the rest of the rules and legislation and said, sorry, if you have a 1040-F, you're no longer eligible, which was far from the truth.
Right.
And so we've been requesting now from the Secretary of Treasury that, in fact, that and there's some other IRC that kind of allows you to utilize 1040-F, the appropriate line equivalent to Schedule C, because of the rest of the composition of the legislation and the rules that are present guidance that we have. So, and so we have some of those other issues that are coming up and it's fluid. And so if you don't get what you think is right, call up Stan, see what, myself, there's a few others that can be called and shop around to other banks, even though it may not be your normal lender of choice.
Okay. One more question that popped in there, Adam, was that, we know the PPP program is out of money right now. We're expecting that to be some new money to be allocated to that. Should people go ahead and apply anyways, get their application in hopes that more money will be allocated. I'm pretty
yes.
More money is going to be allocated. So.
Yeah, I'm confident there's going to be more money. It's going to matter of is it going to come with some additional rules or additional criteria? Maybe. It depends on what can be negotiated between the Dems and the Republicans today. We're hoping that there might be funding by the end of this week. Right. So we think it's going to come relatively soon. And having this rest, we don't think is a bad thing necessarily. We're hoping that some additional rules and guidance to deal with some of these other issues we've been requesting resolution to will occur. But I would say get them in line. Some banks have just said we're not taking any more applications until the funding is there. Others are kind of putting folks in line. What's going to be interesting and what we don't know is exactly when did the money run out. Some of us are actually anticipating it was probably a day and a half prior to when it was actually vocalized because of applications in process. So we don't know how that has been developed, and we are now seeing that some banks may have been prioritizing larger loan values because of the percentage that they make off of those loans, which was not the intent. SBA and many other smaller banks was first come first serve, which is typically the intent of SBA loans. But again, guidance may not have necessarily necessitated for this particular one that's what the banks had to do. We don't know. Anything else, Stan?
Well, that's it in the question box, chat box.
Okay, so I'm not going to spend much time at all on the economic impact payment. I'm going to go through it really, really fast, but it will be in your slide deck. Some of you may or may not be getting any questions. I have not gotten as many questions on this as I have other things. Essentially, eligibility, just about every legal resident is eligible for payments. It's determined through tax documentation. The IRS is going to look for a 2019 tax return on file to determine eligibility and the value of the economic impact payment. If that's not on file, they move to the 2018 tax return. If you have not filed for these last 2 tax years, they're going to look at these 1099 for those that receive Social Security. If you have not been receiving Social Security, they will take a look to see if you receive any of the railroad retirement benefits. That's what RRB 1099 is coming from. If, in fact, you have not filed and you do not receive any of this, you may be dead to the IRS, and they have no other method right now to be able to know whether or not you are eligible. And so what they have done is there's this link here for folks to go to. They're calling it the non-filers entry payment info, but for those individuals that were in fact even filing but do not have an e-deposit being made for tax return purposes, you could actually even go there and update your information. And there's a number of reasons why we have people that may not have filed and do not receive SSRs or RRBs. So, and they are out there even within our ag community. And so if they go here, they fill out, they're going to have to go here, fill out the necessary information, and that may make them eligible to be able to receive a payment. Now, eligibility is going to be determined on your adjusted gross income. There's a threshold level, and beyond the threshold, there's a threshold level and then a 5% phase out for every dollar above that level. Maximum potential payment is $1,200 per individual, $500 per qualifying dependent child. A qualifying child is a child, stepchild, adopted child, or a descendant of the person that is claiming them. That could be brother, sister, niece, or nephews that the taxpayer cares for and is claimed on the tax return. Child has to be younger than the taxpayer, younger than 19 at the conclusion of the filing year. A child that is younger than the taxpayer but younger than 24 if they are a full-time student also is included, or a child of any age that is permanently and totally disabled. So if you're a single individual and you make less, if you're under $75,000 for AGI, you will be eligible to receive the maximum economic impact payment of $1,200. Anything above that number gets reduced 5% dollar for dollar. Married filing jointly, the max payment you have to have to receive a max payment, you have to have an AGI of 150 or less. Head of household is 112.5 or less to receive a $1,200 maximum payment. By the time a single individual gets to $99,000, you have exceeded the AGI limits and the phase out. You no longer receive any payments. 198 for married filing jointly. Head of household, you hit that at 136.5. But if you are going to be a married filing jointly or head of household with one child, let's say that one child is $500, that gets added on to the $1,200 for each individual. So that means potentially as married filing jointly with one child, you now have the potential to receive $2,900. If I meet all other criteria, head of household, you're up to $1,700. So once married filing jointly with one child reaches an AGI of 208, you don't receive any economic impact payment. You have to hit 146.5 before you no longer receive any payment. Okay, and so essentially every dollar below that you're receiving 5% portion until you get down to so essentially for head of household 136.5, you're no longer receiving $1,200. Between the 136.5, just above that you still may receive $500. Once you hit the 146.5, you're not receiving any of that either. Here's some references to be able to go and look at for that. So that was the down and dirty with regards to that. Some contact information for Stan and I. And again, on the slide set you'll receive, there's a number of links that we have to various agencies. And a lot of these are continuing to update information and resources, our Justice for All, and again, our wonderful disclaimer.
All right, Adam. Well, I think we're at the end of our, close to the end of our 2-hour time block anyway. So if there are no more questions, we'll conclude the meeting. We thank all of you for coming out. Appreciate Dr. Kantrovich's willingness to come on and speak to his long lost colleagues and share some of the things that he's been working on. Adam's been a great partner on some articles with me that are also up on that Farm Business Management website. So I encourage you to go to that. I've got links up there as well to some resources, including Adam's page at Clemson that has additional resource links as well. So I encourage you to take a look at those, direct producers to those links. And please feel free to contact either of us with any questions that you might have down the road. Certainly send producers our way as well that may have questions. So thank you all for attending. Thank you, Adam, for your presentation as well.